Hello, hello, and hello. We're back.
Another episode.
Final episode for the season
Yeah.
for 2025. We'll be back in 2026.
Looking forward to it.
But for those who don't know, I'm LaShawna,
I'm Kelvin.
and this is the Family Fortune. So to kind of close out 2025, because when we're taping this, we're like, almost midway through November now?
Yeah.
And so I think it would be a good idea. Is my mic up?
We can hear you.
Mic check. No, I'm just kidding. I know he's going to keep that in. We thought it'd be a good idea to talk about how to prepare for your taxes.
Absolutely.
You know, preparing for your tax season. And even though it says tax season, in my head it's tax season 2025 because we're doing taxes for the year 2025. But if you talk to anybody else, it's going to say tax season 2026 because they're actually talking about the season where you file taxes when it opens up in January. Kind of the end of January
enough
until April, whatever day it is in April. Mm-hmm. It's usually the 15th, but it depends on whatever that. What is it? Tuesday?
Like a Tuesday.
Yeah, whatever that Tuesday is. So you've done taxes before. You've done at least your own.
Yeah, I've done my own. I've had tax conversations as far as like being in the banking realm, exactly what people should be doing with some of that tax money. And how to get ahead with receiving kind of lump sum of money and what we could be creative doing with it. But I stay out of the realm of knowing the tax intricate things. But I know you have some experience with that.
A little bit of experience. But I always like to tell people, first of all, taxes is not free money. Let's just clear that up. It's not free money.
That's actually your money that they're giving back.
Yeah, you overpaid in the previous year. So if you get a refund when you file your taxes next year, it's because you overpaid.
Okay.
And if you owe, that's because you didn't pay enough. You might want to be looking at them deductions.
Yeah.
But how do you get started? So first thing you do is, you know, especially if you are a new tax preparer, if you only have like the one little, I don't mean to call it little, but if you only have one job, like when I first started doing taxes for myself, I was you know, fast food restaurant, what have you. Yeah. You can do an easy form, what's called a 1040 easy. And that's pretty much one little line, one little sheet.
Line item kind of
and
stuff.
You got one income. But we're not going to even get into that deep of it because when you have questions like that, we're going to advise you to go to your tax advisor or talk to a tax professional. There are a lot of free places out here that you can get your taxes done. VITA.
Yeah, and we have a lot of folks in the church, I think, that specialize in taxes as well.
I couldn't tell you their names, but I'm sure they'll make themselves
be.
So, but in order to do that, either if you do it yourself or if you go to a professional, you got to make sure you have everything. So start now and getting organized.
Yes.
Getting all your financial documents together. Your W-2s, which is your income from your employer.
401k contribution documents. Wait for you, so you can get those and file those as well. Because you get deductions for contributing to 401ks. And a lot of time, people get the W-2 and just file because they're like, let me just get it in and send it off.
But there's so much more. That's why if you only have the one job, you can probably do that. Yeah. One income. But if you have like multiple jobs or you have investments or you have bank accounts.
You want those items.
You need to wait until you actually get those documents. And the entities that will provide them, they have until the end of, until February
to get them.
They have until February because we don't even have to submit them until mid-January. In January, we have like until January 31st to get our copy to the IRS and to get them out and to get them in the mail at least. So a lot of times, don't be in such a rush. But like I said, make sure you have all your documents. If you have rental property, if you have housing property, if you got more, get all your documents together. And, just a rule of thumb, don't wait until now. Keep everything kind of together in one spot anyway.
That comes with organizing kind of like the proof of rental history.
Right.
Organize those things. And you can go online and get 401k statements. Right. And like investment statements.
But they don't, they don't have to come out until like February. So just be a little bit patient. So education, if you have tuition, you get those, 1099-T for tuition. You get all those things.
And you want to file them. You want to file them accurately because you don't want to ever get to a year where you're being audited or something like that, and you've missed those things.
Right.
So you want to make sure you have all, I mean, I know I've made a mistake previously on filing too soon without my 401k deductions, and I missed out on some money. So I was like, oh, I won't be doing that again. You don't want to miss out
on the money.
No.
Okay. So once you've gotten all your documents together, you know, make sure you have everything. Then you want to make some decisions. If you're single, like I am, you can, but there's 2 options for singles, especially if you have dependents. If you don't have dependents, it's just single.
Yep.
If you have qualifying dependents, someone under 18, or they're still in school, you can probably try to file head of household. If you're married, make a decision. Are you going to file married filing single?
Or joint.
Or joint. Married filing separate.
Married filing separate.
Right.
Which I feel like you tend to pay a little bit more. I mean, just depending upon the situation. It just
depends upon, I mean, there's certain things I don't know. Never been married. So certain things that I think would make that decision, like maybe one has debt and they don't want to have the other.
Included on it.
Included on the debt. Just certain things. If you have questions, make sure you talk to a professional. Okay, so you have to decide how you're going to do your deductions. Are you going to take the standard deduction, where the single, head of household, married filing separately,
or the itemized,
or itemized? For me,
gets very in depth.
It is. So find out what the deduction is, the standard deduction is for however you're going to file, and see if you're going to even have enough equal to or greater than for deductions.
Yes.
So if the standardized deduction is higher, you might want to stay with that. But if your itemized deductions take you above the standardized deduction, maybe you want to go that way. Yeah. But then you got to make sure you have all your documents
to support it,
to support the itemized deductions.
Yeah.
Okay. Then if you're a business owner, or you've had previous years where you owe, you might want to see if you have to consider estimated tax payments. You know, whether you have enough withholding, because withholding means the money that they're taking out
from your earnings.
Your earnings. Maybe check and see if you're taking out enough.
Should be. My experience with being a small business banker, we would set up an account separately for tax season, because most of the time as a small business owner, you know you're going to be paying something. So we're going to do, you have your write-offs, of course, seek professional tax help with that. But you have your write-offs. But at the end of the day, you're probably going to have something that you got to pay. So we're like, set up another account to kind of hide some money away.
Right.
So when we get to that point.
And I learned how to do that. I actually been doing that every year. So you can either pay quarterly, you can pay monthly, or you can do at the end of the year.
Yeah.
For me, it's easier to just do it at the end of the year. But that means you got to keep track of all your income,
expenses,
and anticipated.
Yes.
Sorry, taxes.
Yes.
Anticipated tax. So you kind of got to know what your tax brackets are, and we're going to get to that in a minute. So you'll know, make sure you're withholding or putting aside the correct amount.
Yeah.
For the correct amount.
Yeah, that's why it's really important to make sure, if you can, spend everything that you need, like for your business, to do it out of a separate business account if possible.
Yes.
It gets really confusing when you're trying to, file taxes and your business expenses are wrapped up in your personal expenses.
You're looking for an audit.
Yes. That's like you're asking for it at that point.
Asking for an audit. Let's see what else. Think about credits that you may be able to get. And so tax credits is, let me see if I can explain this. So there's a difference between a deduction and then there's credit.
Yeah.
So deduction is money you take away off of, you can subtract from your annual income. Let's say your annual income comes up to like $50,000. Your deduction, like I said, when we talked about before, are you going to take the standardized deduction or the itemized deduction? That's money you take away from your income. So you're decreasing your annual income, which is a good thing, because then it decreases your tax bracket. Credit is you get exactly almost what it says. You get some sort of credit for having done something or spent something or put something aside. Like you can get credit for child care, you get credit for earned income.
Earned income.
You get some
child care, tuition as well. Because I think
that.
if you pay for your child's tuition, like in private schools or charters,
if
I
you
think
do
you can
IRAs,
claim that as well.
If you do investments like your Roth IRAs, you get credit for those things, and that's money that kind of
brings down your taxable income.
Thank you. I was speaking. It brings down your taxable income, what they say you're supposed to pay.
Yes, which means you bring it down, and hopefully you fall out of one of those buckets that you kind of are going to talk about, and then you pay less taxes.
You pay less taxes.
Yeah.
So make sure you understand what you're entitled to as far as your credits. I don't really get credits anymore.
Yeah. They start snatching them away pretty quick.
Yeah.
Once you get to a certain income, they start.
Well, not even income. I used to get child tax credit.
That's gone.
Long gone. I'm not in school anymore, so I don't get any more tuition. I get a little bit of credit with my investments, retirement, saving for retirement.
That I get, like, because I contribute to the 401k. That's about like the only credit that I qualify for, and they're getting rid of that EV credit that you get for Teslas. So I wonder how that's going to affect people.
It's going to, and we're going to talk about that too. So
yeah, we talked about a whole bunch of stuff. And that was yearly. I think that was a yearly thing they used to get for having an electric vehicle. I think that's
I can't remember. Oh, it was done way before that.
Was it? Oh man.
So when they did don't ask me which president it was, but when they did the 2017 thing. When they changed a whole bunch, and when they did 2017 tax law or tax credits, dealing with the whole Affordable Care Act and a whole bunch of other things, they got rid of some of those deductions back then too. I think the EV was grandfathered in a little bit longer, but it went into effect a while back. Talk about what you need to do. Get all your stuff together.
Oh yeah.
Check what you may need. Check how you're going to file. Are you going to file single? How are you going to file? Whether or not you're going to have a standardized deduction or itemized. Check into what kind of credits you may be able to get. And last but not least, make sure you just consult a professional. Yeah. If you have questions, because the tax laws and the tax books and all the tax stuff,
it can get confusing.
I
mean, if I think we have resources in the church, people that do taxes as a profession. I mean, if not, go online. You have TurboTax. You have those kind of
I recommend VITA. VITA is a free program because that's going to be one of the things we talked about, that IRS did away with the free filing. There's no more free filing anymore. It only lasts about, a year? Been here.
Oh, my goodness.
So VITA is a volunteer.
I have to pay to get my money back.
I know. But VITA is a volunteer program. People actually go through training. They probably already started training in preparation for the tax season that's come up. And you can usually find those at your library. Okay. They have, like I believe Wallace next door has people that come in and do that. AARP offer services. Okay. There's a lot of free services out there if you just need free services.
File with some kind of backing or somebody with some knowledge, because filing incorrectly could just be a pain.
Can be a pain.
That next following year.
And if you have a complex, or you already know you're going to have a complex tax return, just consult a professional. There's plenty of professionals out there. Please. So let's talk about making sure people understand the brackets, the tax brackets. So a couple of years ago, tax brackets became a thing. It used to be kind of, you find your income and you make sure you don't go above it. So it'd be like 35 to 45 single. Yep. This is your tax. And it was probably 20% or what have you. Yep. Now it's in brackets. It's still 25. I'm just using income, 25,000 to 35,000. On that first 25,000, you're going to pay 10%.
Yes. Anything additional
after that, you go to 12.
Bump up.
You bump up I'm just using 12% because I'm using my tax brackets. So up to my first 25,000, and actually that's a little high. I think it's 11,000. I think it's $11,000. You pay 10% in taxes. You should calculate 10% in taxes. From 12,000, I want to say, to like 25 or something like that. You pay 12% on that.
So
if you make it's a tier. So if and then anything over 25, you pay something else. So you're having 3 different tax brackets. So you always got to make sure you're in the correct bracket. I figured out my calculations a couple of years ago in using my Excel spreadsheet. Yes. We were just talking about that.
We do one Excel spreadsheet. We're just like Excel pros.
And it calculates my income for me. So, because, trying to do it in my head. I mean, my taxes for me.
Not going to work.
In my head, it doesn't work. So make sure you understand your different tax brackets. And let's see what happened. So that's the main thing. That did not go away with this big, beautiful bill that they passed earlier in 2025 and put in a whole bunch of new changes that you need to consider when you're filing your 2025 taxes. So some of the key changes were they kept the brackets, the step-up brackets for determining how much income you should pay. But then the standard rate, it tells us right here, the tax brackets, they start at 10, then it jumps up to 12, then it jumps up to 22, then it jumps up to 24%, 32%, 35%, max being 37. I would hopefully never see 37.
Or maybe do you want to see 37?
I don't want to see 37.
Because that means the income will be...
The income is higher. Yeah. We're talking millions.
Well,
up, at least over $150,000.
Yeah.
Is 37.
That's a lot.
That's a lot. I don't think I've ever seen that. And so the standard deductions, remember we were talking about the deductions where you can either take the itemized or the regular standard. For single filers, it's $15,000. Went up. Yes. $15,750. So off the rip, if you're filing single, $15,750 is non-tax. Let's just put it that way. It's kind of non-tax, if that makes sense.
I saw this study too where it says that people filing single pay more in taxes.
Yeah.
And I'm like, it's a little bit unfair.
Well, we don't get as many tax breaks and credits, and that may be why it seems like that. Because if you're single, and that means you don't have any dependents, you're not claiming anyone, you don't get those credits and deductions, that someone else may have.
And I was like,
so it's just straight tax.
Straight tax. You're not getting any breaks unless you you contribute to your 401k, or maybe you can prove that you pay daycare for something.
I don't even really get credit for that either.
It's very small.
And so mine was just whenever I do mine, it's just be like, okay,
unless you're doing and max out the 401k,
right?
And then
you literally have to almost contribute almost $10,000 for the year in order to get credit for that $10,000. I don't do that.
No,
so
most people don't.
So married filing jointly, it went up to $31,500, and if you file head of household, $23,625.
Okay.
As the standard deduction. I always take the standard deduction. Now, if you decide to itemize, they have this called the state and local tax. It's called SALT. I don't think too many people in the South are going to be affected by it. It's primarily people up north who have high property tax rates.
New Jersey, those kind of areas like that.
So they can deduct or get credit for up to $40,000 off their property taxes. Oh, yeah. So if you itemize, those are the people that's going to be itemized because they can take 40.
Florida, when I moved from Florida, Florida's property taxes are extremely high. Definitely different from Georgia when I moved here. And you're able to write off, I think, a portion of your income taxes. I mean, your property taxes, and as well as the interest paid on your mortgage.
Yes, you can still
do
that.
Mortgage statement
but
too.
it's higher now.
Oh man.
Because I think it was a cap before. It was really low. So those who stayed in the high property tax areas were like, whoa. Yeah. It was a whole bunch of grumbling and fumbling. So they increase the SALT to appease them. So even down here, you can still itemize your property taxes, your interest, and everything else. The thing is, the SALT increase is going to phase out in 2029 unless they change the law again. But right now, it's scheduled to phase out in 2029. So it's only temporary. Okay. Another big one are some new deductions you can take if you itemize. Also, some new credits. So you can deduct interest now for a qualified loan used to purchase a vehicle, a passenger vehicle. And it's up to $10,000 per year. You can deduct up to $10,000 per year. That phase out in 2028. And for personal use vehicles, I think it's like you got to make over 100K.
Okay.
No, I'm sorry. It phases out for once you reach 100K. You're not able to you're not able to take the deduction
once
if
you
hit that.
Then you can't qualify anymore.
And that 100K is for single filers, and for married filers is 200K.
Oh, and they increased the child tax credit again?
They did. Okay. So, but we're going to get to that one. The next one
I'm
is
jumping around.
Something that I think is fairly new is you can deduct your tip income. So for tipped employees, waitresses, barbers, what have you, you just have to throw that in with your income. It's just all income, income. And any overtime.
That's a good one.
So I don't. So you can, and the overtime is for everybody, not just tipped people. So tipped people or tipped workers can deduct some of their tips, and people who get overtime can deduct some of that, or it doesn't count against their income. So the tip income deduction is up to $25,000 for certain taxpayers. You have to look that up because I don't know who all the certain taxpayers are, but I'm pretty sure it's like I said before, waitresses, barber, the ones who that is their primary source of income. And that phases out in 2028 though. So it's not forever. So take advantage of it now. And for the overtime pay, which is for anyone who gets overtime pay, because, before it just goes into your income, but now you can deduct that or don't have it count. You can deduct up to $12,500 if you're single or $25,000 if you're married. And that also phases out in 2028. So if you want more specifics on the who, I suggest go to irs.gov and it'll give you the who, or consult a tax professional. They did increase the child tax credit. It's now up to $2,200 per qualifying child. It starts this year, and this is going to be indexed for inflation, which means I guess it's going to go up each year in accordance with inflation. And then for seniors 65 plus, they get an additional deduction that phases out once they reach a certain level. Again.
Which they should, because I don't know if you do know, people that receive Social Security still get taxes deducted from their Social Security check, which is always very confusing to me, that they're getting Social Security while paying for Social Security. So,
I know. Right. I make your head spin.
Yeah.
So for small business owners, what they put into place and made permanent is the qualified business income. The 20% qualified business income deduction has now been made permanent. But there are phase out thresholds, married filing jointly $150,000 and some more. There's 100% bonus depreciation for property acquired and placed in service after January 19, 2025. Includes certain manufacturing property. That has been made permanent. So if you purchase a vehicle, let's just take a vehicle in 2025, and you put it into service, that means it became your business vehicle, and you claim it as a business expense. You can get 100% depreciation on that.
Well, that's
good.
Good. Very good.
Very good. But only if you got the vehicle or property or what have it after January 19th.
Logo on my.
But did you buy it after January 2019?
I didn't.
Okay. And I don't know what this is. I have to look it up myself. But for those who may know and care, Section 179 deduction has increased. It increased to 2.5 million. That's probably why I don't know about it. And the phase out threshold increased to 4 million. I don't even know how many zeros that is. That's a lot of zeros. Some things have been phased out and eliminated. Some credits and deductions. Usually, I'm talking about the energy efficiency.
Yeah.
And the clean vehicle credits terminated. Terminated. So have the home energy efficient improvement credits. They all end at the end of this year. Mm-hmm. So you may still be, you got probably one more year to claim it. Yeah. You got this year to claim it. You ain't gonna be
2025, that's it.
That's it. The previous personal exemptions for dependents remain eliminated permanently. And then other miscellaneous deductions such as unreimbursed employee expenses, investment fees. So a lot of things that were on the deductions, the Schedule 1040A, it was, it's a lot.
Long list.
A lot of that has gone away. Because people will just, you can find things to plug in to get beyond the standardized deduction. You're not going to be able to do that anymore. Yeah. You're not going to be able to claim all that stuff. Charitable donations, a lot of that's gone. Wow. So consult a professional. Or if you're savvy enough, go to irs.gov, get the publication 17, and you can get free publications, free forms, free everything from the site. Mm-hmm. All you got to do is order them.
Yeah.
And they'll send them to you. Or probably in the next month, go to your local library. They're going to have the publication sitting right there free for you to take. Not only the publication, but the forms. If you want to give it a
go yourself, the knowledge is there. I mean, if you wanted to give it a go yourself, the tax codes, you can look them up. You go on irs.gov. But
I always encourage people, not saying use that as what you're actually filing, but I always encourage people, learn how to do your taxes.
Yeah, and at least learn what the stuff means.
Yes, because if you go to a professional, you want to know that what they're putting on the form is accurate and that they're not going to come after you later. Know what your stuff is. See, me, I want to know. My signature's going on it. I want to know if I got, especially if I got to pay.
Anything that's owed, I'm like, I need a follow-up question on this.
Mm-hmm. Yeah. I do your due diligence. Don't just take the word of someone else.
Yeah.
You want to make sure that you're not getting scammed. You're not getting taken for a ride. Yeah. And you just want to know. I mean, not saying you have to do it.
They come around the next year. So if they're done wrong, they don't disappear.
They don't.
They just come back around in a year or two. Mm-hmm. And, you have to address them then.
Okay. I don't think I know we put out a lot to y'all.
That was a lot of information.
We put out a lot.
They can slow down the video or rewind if need
And we
be.
wanted to go out with a bang.
Yes.
Because we're going on vacation.
Yes. We're going to be starting again, though. We're excited for 2026.
We're going to be starting again. There's a lot more stuff coming up. Not going to really throw it out there yet because it's not finalized. But be on the lookout. And if you've ever attended one of our sessions, we do have your email, so we'll keep you informed.
We want to just say thank y'all for coming out and supporting.
Yes, it's been an awesome year.
2025 has been good.
It's been a great year. Yeah. We thank every last single one of you that
watched the podcast, come to the class, left good reviews.
Right.
We
just say hey.
That.
Yeah. So until 2026, it's me, Girl Lashana.
It's Kelvin.
And Malcolm hiding in the corner.
He's always there.
Bye.